Everybody wants to get rich quick. But what if I told you there's a simple math formula that shows exactly how fast your money can double? And no, it's not a scam. It's not crypto hype. It's just basic math that every wealthy American understands. The secret is called the Rule of 72. It's one of the simplest and most powerful formulas in personal finance, yet most people go through life without ever hearing about it. And the truth is, if you don't understand this rule, you're probably leaving a lot of money on the table. Here's how it works. Take the number 72 and divide it by the annual return rate of your investment. The answer tells you how many years it will take for your money to double. That's it. No Wall Street jargon, no advanced degree, just middle school math. Let's break it down with an example. If you put your money in an account that earns you 6% a year, divide 72 by 6. That gives you 12. This means it will take 12 years for your money to double. If your investment earns 12% a year, now 72 divided by 12 equals 6. Suddenly, your money doubles every 6 years. Think about what that really means. At 6%, $10,000 turns into $20,000 in 12 years. But at 12%, that same $10,000 doubles in just 6 years. And in 12 years, it's not $20,000, it's $40,000. Same starting money, completely different outcomes just by understanding and applying this rule. The Rule of 72 is the math behind how the rich think about time, money, and opportunity. And once you see it, you can't unsee it. Now that you understand the Rule of 72, here's the part that really separates wealthy Americans from everyone else. Time. The earlier you start investing, the more doubling periods you get in your lifetime. And every extra doubling makes a massive difference. Let's do some math with a small amount. Suppose you start at age 25 with just $5,000 and you manage to earn an average return of 10% per year, which is roughly what the stock market has historically delivered over the long run. Using the Rule of 72, you divide 72 by 10 and get 7. 2, that means your money doubles roughly every 7 years. So at 32, your $5,000 becomes $10,000. By 39, it's $20,000. At 46, it's $40,000. By 53, it's $80,000. At 60, you're sitting on $160,000. And by the time you're 67, that little $5,000 has snowballed into over $320,000, all without adding another penny. Here's the kicker. If you waited just 10 extra years to start, at age 35 instead of 25, you would cut out one doubling cycle. That means you'd end up with less than half the amount by retirement. That's the brutal truth most people miss. Procrastination kills wealth. Wealthy people don't get rich overnight. They get rich because they give their money more time in the market. They don't sit on the sidelines waiting for the perfect time to invest. They understand the perfect time was yesterday and the second best time is today. So if you're listening right now and you haven't started yet, don't wait. Every year you delay is another doubling cycle lost, and trust me, that's expensive. Now that we've talked about time, let's look at the other side of the equation, your rate of return. The Rule of 72 makes this crystal clear. The higher your return, the faster your money doubles. Let's break it down. Say you invest $10,000. If your average annual return is 6%, 72, 6 per hour, 12 years. Your money doubles every 12 years. That's solid, but it's a slow climb. Now let's raise the return to 8%. Suddenly, it only takes 9 years to double. At 10%, it doubles every 7 years. And if you manage to hit 12%, your money doubles in just 6 years. That difference is massive over time. Here's what it looks like in real life. At 6% return, $10,000 grows to about $40,000 after 24 years. At 10% return, that same $10,000 grows to over $100,000 in the same time frame. At 12% return, you're looking at more than $160,000. This is why wealthy Americans pay so much attention to where their money is invested. They don't just park it in a savings account earning 1% or 2% interest, because at that rate, their money would take 36 to 72 years to double. That's basically a lost lifetime. Instead, they look for smart ways to earn higher returns. Low-cost index funds, real estate, or even businesses. They know that every percentage point counts. Over decades, the difference between 6% and 10% isn't small, it's life-changing. So here's the takeaway. You don't need to chase risky, get-rich-quick schemes. But you do need to care about your return rate. Because when you combine a solid return with enough time, the doubling effect becomes unstoppable. A lot of people hear these numbers and think, yeah, but I don't have $10,000 to throw into the market right now. And that's where most folks make a big mistake. They assume you need a huge amount of money to take advantage of the Rule of 72. The truth? Starting small still works. Let's take an example. Imagine you only have $5,000 at age 25. That doesn't sound like much. But let's say you invested in an index fund that averages around 10% a year, which is roughly the historical average of the US stock market. Here's what happens. By age 31, it doubles to $10,000. By 37, it doubles again to $20,000. By 43, it's $40,000. By 55, it's over $160,000, all from that original $5,000 with zero additional contributions. That's the magic of compounding. And here's the best part. If you add even small, consistent contributions, say $200 a month, the numbers explode. By the time you're in your mid-50s, you're not just looking at six figures, you're approaching seven. This is why wealthy Americans never laugh at small beginnings. They know the formula doesn't care how much you start with. It only cares about time and return rate. So instead of thinking, I'll invest when I have more money, flip the script. Start now, even if it feels tiny. Because waiting 5 or 10 years to get started costs you way more in lost compounding than starting small ever will. Your first few dollars are like planting seeds. Give them time and they grow into trees that keep multiplying. Now that you understand how the rule of 72 works, the question becomes, how do you actually apply it to your own money? The answer is simple. Use it as a mental shortcut every time you look at an investment or savings opportunity. Let's say your bank is offering you a savings account with 1% interest. Divide 72 by 1, and you get 72 years for your money to double. That means if you put in $5,000, you'd have $10,000 in the year 2097. Not exactly exciting. Now compare that with an investment averaging 8% returns. 72 divided by 8 is just 9 years. That same $5,000 doubles every 9 years, which means you're hitting milestones multiple times in your lifetime, not once at the end of it. That's why wealthy Americans prioritize assets like stocks, index funds, real estate, and businesses, because the math of doubling works in their favor. They don't waste decades in low-interest accounts when they could put their dollars in vehicles that compound faster. Here's the mindset shift. Don't just save, invest. Don't just earn money, own assets. And don't just hope things get better, use math to plan your future. If you start applying the rule of 72 today, even with small amounts, you'll see that wealth building isn't magic, it's a formula. It rewards discipline, patience, and time, not luck. So here's your action step. Take a look at your money right now. Where is it sitting? What's the return rate? Do the rule of 72 math. If the timeline to double your money feels too long, it's time to make a change. Because the earlier you start, the sooner your money starts working harder than you ever could.